Yeah. At its peak, WeWork carried a private valuation of $47 billion. It had planted its flag in hundreds of cities, signed leases on millions of square feet of commercial real estate, and persuaded some of the most sophisticated capital allocators in the world that what they were funding was not a property company, but a technology platform. Within months of attempting to go public, that story fell apart in full view of the market. By November 2023, WeWork and certain of its subsidiaries had filed for Chapter 11 bankruptcy protection in the United States. The distance between those 2 points is not simply a story about excess or a charismatic founder. It is a structural failure that was legible in the business model from the very beginning, and it compounded with every dollar of growth. The original problem WeWork set out to solve was real. Commercial office space was expensive, inflexible, and poorly matched to the needs of small companies, early-stage startups, and independent workers who needed professional environments without committing to decade-long leases. WeWork's answer was to position itself between landlords and end users. It would sign long-duration leases on large commercial properties, redesign and subdivide the interiors, and then sell access on short, flexible terms. Desks, private offices, and entire floors available by the month or even shorter. The arbitrage looked compelling. Buy wholesale, sell retail, and build a global network whose value would grow as it scaled. For a period, the model attracted genuine demand. The rise of distributed teams, freelance workers, and venture-backed startups created a real market for exactly what WeWork was offering. The spaces were well-designed and well-located. Members valued the flexibility. SoftBank, through its Vision Fund, became the company's most consequential financial backer, supplying capital at a scale that allowed WeWork to expand far faster than any organic business logic would have supported. The growth was real. The question was always what it was built on. The flywheel fed on itself in a way that made the underlying economics easy to defer. More locations attracted more members. More members supported higher private valuations. Higher valuations unlocked more capital from investors who believed the trajectory would continue. More capital funded more locations. At each turn, the losses were framed as deliberate investment rather than structural cost. The lease obligations were treated as assets rather than fixed liabilities. The valuation was presented as a reflection of future potential, not present performance. That framing held as long as the capital kept flowing. By 2019, WeWork was preparing for an initial public offering. The private valuation stood at $47 billion. The company had become a cultural emblem of the new economy, its spaces filling with exactly the kind of workers and companies that defined the era. That peak, however, rested on a foundation that the IPO process was about to expose to public scrutiny for the first time. What had been a private story, told to a limited audience of investors who had already committed capital, was about to become a public document. So, the structural weakness had been present from the start, and it was not subtle. WeWork's business model created a fundamental maturity mismatch. The company held long-duration lease obligations, often spanning a decade or more, while selling memberships on terms that members could exit with relatively short notice. In a stable or growing market, with high occupancy and steady membership renewal, that mismatch could be managed. In a downturn, or even a period of slower growth, it became a trap. The fixed costs embedded in those long leases would remain regardless of what happened to revenue. The company's SEC filings and subsequent bankruptcy disclosures would confirm the scale of these long-term lease obligations as a defining feature of its liability structure. When the IPO prospectus became public in 2019, analysts and institutional investors read the financials carefully for the first time. What they found was a company losing money at significant scale, with no demonstrated path to profitability and a governance structure that concentrated substantial control in a single founder. The market's reaction was swift and decisive. The proposed valuation was cut repeatedly as investor appetite failed to materialize at any price that justified the private figure. Institutional investors declined to participate. The offering was postponed and then withdrawn entirely. SoftBank, which had been WeWork's most important financial supporter, disclosed a major write-down of its WeWork investment in November 2019, reflecting a sharp fall in the company's estimated fair value. In October 2019, SoftBank had announced a rescue financing package, taking on a larger ownership stake as part of a broader restructuring. The founder departed. The company began cutting costs, reducing headcount, and attempting to rationalize a lease portfolio that had been assembled during years of expansion in which growth was the only metric that seemed to matter. Then the pandemic arrived and removed the remaining assumptions the business had been resting on. The occupancy model WeWork depended on, dense, shared spaces filled with workers from many different companies, moving through common areas and sitting at adjacent desks, became precisely the kind of environment that businesses and individuals were actively trying to avoid. Membership revenue fell. The long-term leases remained. The gap between what WeWork owed its landlords and what it could collect from its members widened in ways that cost-cutting alone could not close. The years between 2020 and 2023 were a sustained attempt to find a version of the business that could survive. WeWork went public through a special purpose acquisition company in 2021, a route that bypassed the traditional IPO scrutiny that had derailed the 2019 attempt. But the underlying economics had not changed. The company continued to report significant losses. Its lease obligations remained a dominant and defining feature of its balance sheet. By mid-2023, WeWork's own public filings included language expressing substantial doubt about its ability to continue as a going concern, a formal accounting signal that the end was approaching. In November 2023, WeWork and certain of its subsidiaries filed for Chapter 11 bankruptcy protection. The Associated Press reported the filing as the conclusion of a years-long decline from one of the most celebrated private valuations in recent business history. The bankruptcy process centered on the company's attempt to restructure its debt and, critically, to renegotiate or exit the long-term leases that had defined both its period of growth and the mechanics of its collapse. The aftermath spread across dozens of cities. Landlords faced the prospect of renegotiated or terminated leases on properties they had committed to WeWork during the expansion years. Members whose workspace arrangements had seemed stable found themselves navigating sudden uncertainty. SoftBank's Vision Fund absorbed losses that became a widely cited reference point in broader conversations about late-stage private market valuations and the gap between narrative and fundamentals. The WeWork brand survived into the bankruptcy process itself, a recognition that the underlying demand for flexible workspace had not disappeared. The market the company had identified was real. The structure it built to serve that market was not. The precise mechanism of WeWork's failure was not reducible to any single cause. Ambition, governance concentration, investor enthusiasm, and external shocks all played a role. But the load-bearing failure was structural and present from the beginning. Long obligations funded by short revenue, with a valuation that assumed perpetual growth and left no margin for any deviation from that assumption. When public scrutiny arrived in 2019 and when occupancy collapsed in 2020, there was no buffer. The leases did not shorten because the memberships did. The costs did not fall because the revenue did. That gap between the duration of what WeWork owed and the duration of what WeWork earned was always the story. The question worth carrying forward is how many businesses built on the same mismatch are still waiting for the moment when the market stops taking their word for it.